The Federal Reserve just quietly agreed to lend money to a country most Americans couldn't point to on a map, and it did it to save you. Not you as in some abstract citizen. You as in your mortgage rate, your car payment, the interest on your credit card. Those numbers aren't set by your bank. They aren't set by Wall Street. They're set by something called the 10-year Treasury yield. And right now, a chain of events is pulling that number higher in ways most people don't see coming. In 2008, Ben Bernanke, then chairman of the Federal Reserve, extended emergency swap lines to 14 countries in a single weekend to stop the global financial system from seizing up. He later called it the most important decision of the entire crisis. We are entering a moment that rhymes. Here's the foundation. Every year, the US government spends more than it collects in taxes. We're talking trillions of dollars more. So to cover the gap, it borrows. And the way it borrows is by selling something called a treasury bond. Think of it as a formal IOU. You hand the government $1,000. They hand you a piece of paper that says, "We'll pay this back in 10 years, plus interest every year along the way." These bonds have been called the safest investment in the world for one reason. The US government has never, in its entire history, failed to pay. So countries around the world, Japan, the UK, South Korea, China, dozens of others, have stacked up trillions of dollars worth of these IOUs. Right now, foreign governments hold roughly $9.4 trillion in US treasuries. Not because they love America, because treasuries are safe, liquid, and denominated in the one currency every country needs to operate globally, the US dollar. That system worked perfectly, until now. Here is the uncomfortable truth hiding inside that $9.4 trillion number. Every single country that holds US treasuries holds them for the same reason. They're an emergency exit. And right now, a lot of countries are heading for the door at the same time. In April 2026, the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's traded oil flows, has been functionally closed for weeks. That is not a small disruption. That is a tourniquet on the global energy supply. Countries that depend on that corridor, Japan, South Korea, the UAE, Kuwait, suddenly cannot get oil the way they used to. And when you can't get oil through your normal channels, you go find it on the open market. And when you go to the open market, you need dollars, because oil is priced in dollars, always has been. So here's what happens next. These countries, energy-starved and dollar-hungry, look at their most liquid dollar asset, and that asset is US Treasuries. Foreign central bank holdings of treasuries at the New York Federal Reserve have dropped to their lowest level since 2012. They are selling now. This liquidation is a major signal. Here's what that selling actually does. When lots of people sell the same asset at the same time, the price drops. When the price of a treasury bond drops, its yield goes up. The yield is the interest rate. Higher yield means the US government has to pay more to borrow new money. And here's where it gets personal. That yield on a 10-year treasury is the benchmark for virtually every major interest rate in the economy. Your mortgage rate is priced off of it. Your car loan, your business loan, every corporate bond on the planet. So, countries sell treasuries to buy oil. Treasury prices fall, yields rise, borrowing costs across the entire economy climb. At the exact moment when the US government itself needs to refinance trillions in existing debt. Higher rates plus more debt to roll over equals a spiral. That is the trap. Let me make this real with a simple example. Say I lend you $1,000 and you agree to pay me back in 5 years at 5% interest. $50 a year. Sounds clean. 2 years in, I have a cash emergency. I need the money now, but you don't owe it back for 3 more years. So I go find someone willing to buy the loan from me. But they can smell that I'm desperate. They offer me $800 for my $1,000 note. I take the deal. I need the cash. Now think about what just happened to that buyer. They paid $800 for a loan that will return $1,000 plus interest. Their yield just went up, automatically, because they paid less. Now multiply that by an entire nation. Now multiply it by a dozen nations. In late April, the United Arab Emirates approached the US Treasury and asked for an emergency financial facility. Now the UAE is not a poor country. It holds roughly $95.6 billion in US Treasuries alone. It has approximately $270 billion in foreign exchange reserves. It controls trillions more through its sovereign wealth funds. The UAE is not broke, its cash flow stopped. Those are two very different problems. When your cash flow stops but your bills don't, you dip into savings. And the UAE's most liquid savings are, you guessed it, US Treasuries. If the UAE had sold even a fraction of those treasuries into an already stressed market, the yield spiral we just described could have started in earnest. Treasury prices would have dropped, yields would have climbed, borrowing costs across the global economy would have risen. So instead of doing that, the UAE did something clever. They went to Washington and made a quiet argument. Help us, or we will have no choice but to destabilize your bond market. What the UAE asked for is called a currency swap line. Very few people understand what this actually is, so let's fix that. Here is how it works. The Federal Reserve agrees to lend dollars to a foreign central bank. The foreign central bank pledges its own currency as collateral, locked at a fixed exchange rate. When the loan matures, the foreign bank pays back the dollars with interest, and that exchange rate stays the same regardless of how either currency moved during the loan period. The Fed has done this before. In 2008, swap lines went to 14 countries in a weekend. In March 2020, they went out again when COVID froze global dollar markets. In every case, those swap lines were repaid, technically, but here is the detail that almost nobody talks about. In 2013, the Fed quietly changed the terms on 5 of those swap lines, with the European Central Bank, the Bank of Japan, the Bank of England, the Bank of Canada, and the Swiss National Bank, from temporary to permanent. A loan that never matures isn't really a loan, it's a commitment. Now, the political argument over swap lines is going to heat up fast. Critics will call this a bailout of foreign governments. Supporters will say these are standard emergency tools that always get repaid. Here is what both sides are missing. The real beneficiary of a swap line isn't the country receiving the dollars, it's the US Treasury market. Think about the alternative. Without a swap line, the UAE sells treasuries. Prices fall, yields rise, everything gets more expensive for American borrowers. With a swap line, the Fed lends the UAE dollars directly, and the UAE has no reason to sell anything. The Fed isn't bailing out the UAE. It's preventing the UAE from becoming a forced seller of US government debt. There is a meaningful difference. The UAE is not the last stop on this train. Kuwait is next. And the Kuwait situation is arguably more alarming because it is more extreme. Oil revenues fund roughly 90% of Kuwait's government budget. In April 2026, Kuwait exported 0 barrels of oil. 0 for the entire month. That hasn't happened in over 30 years. Kuwait holds $66 billion in US Treasuries. When a country that funds 90% of its government through oil exports 0 barrels of oil for a full month, it has 2 options. Sell assets to raise cash, or ask for a swap line. Those are the only 2 levers. If Kuwait sells its treasuries, that's fuel on a fire that's already burning. Here is the prediction I want to put on record. Over the next 12 months, the swap line program is going to expand dramatically. And with it, the list of countries the United States has quietly accepted financial responsibility for will grow. We will go from the current standing partners, the ECB, Japan, the UK, Canada, Switzerland, to a much wider net of countries with less stable currencies and less reliable finances. As the eligibility criteria drops, the fragility of these arrangements goes up. And second, the number of swap lines that shift from temporary to permanent, like the quiet 2013 announcement, will also grow. On the books, each one looks like a loan. In practice, they roll over. New swap issued to repay the old one. Wall Street has a name for this pattern. They call it amend, extend, and pretend. Pull back even further, and something bigger comes into view. For 80 years, the US dollar has been the world's reserve currency. Every country holds dollars. Every country needs dollars. That gives the United States what economists call an exorbitant privilege, the ability to borrow cheaply from the whole world, essentially forever. But that privilege comes with a hidden obligation. When the global system runs short on dollars, the world looks to Washington. And when Washington says yes, as it almost always does, it assumes a little more of the world's financial risk. Each swap line is a small extension of that responsibility. Each permanent swap line is a permanent extension. At some scale, the US stops being a country with a central bank and becomes a central bank with a country attached. So here is the question I want to leave you with, not whether the Fed made the right call on the UAE. That's a political argument, and smart people land on both sides. The deeper question is this: If the United States is the lender of last resort for the entire global dollar system, not just formally, but effectively, what does that mean for the dollar itself? What does it mean for interest rates, for inflation, for the people paying those mortgage bills? The UAE wasn't the end of the story. It was the first domino.